Good. So why don't we kick off? Good afternoon, everyone. Very happy to be here. Just getting my tech working. My name's Tim Baker. I run IEX Cloud, and I'm really delighted to be hosting this webinar on the topic of corporate event data. It's part of a series that we are doing, talking to our partners who are deep domain experts on the content that they create and curate. And last time we talked about fundamental data, which we source from the SEC directly, but more importantly, we get a highly curated financial feed from new constructs. And today, as I mentioned, we're going to talk about corporate event data. And I'll let Christine and Michael introduce themselves a bit later, but they come to us from Wall Street Horizon, one of our earliest partners on the platform. The agenda for today is pretty much as normal, and we hope to leave about 10 minutes at the end for Q&A. First, a quick disclaimer, as always, we will make reference to some companies and examples, but clearly none of this should be construed as a recommendation or solicitation to offer to buy or sell securities. I really encourage the audience to chip in with questions and comments as we go along. Some of them we might interject into the conversation. We'll do our best to answer all the questions, but given the limited time, we may not get to all of them. Please feel free to reach out to IEX Cloud afterwards and myself with any follow-up questions. And to ask a question, use the Q&A box. Don't use the raise hand functionality. So the Q&A box, and we'll monitor that as we go. And we are recording this session, and we'll send around a link later on, should you want to share that with friends, family, and colleagues. So as is our tradition, we'd like to do a quick topical poll to the audience. So let me find the poll button. I'm going to launch the poll. So if you could take about a minute, and we'll review the results. And there's a fun question at the end, so do try and get to the end. Can everyone see the poll? There we go. Now some people have started. Just give it a few more seconds. Okay, so let me end the polling. I'm going to share the results. Can you folks see the results? Yes, okay, good. So you can see good mix of people on the call, a mixture of folks from enterprises, independent developers and investors, as we expect, some academics. We're going to have a talk a bit later on looking at academia. Obviously a big focus on US, but also some folks from other parts of the world, and even one person from Asia, so thank you. It's very late in the day there. This was a question from our partners, and quite interesting, quite a wide spread of views there. I think that's going to play quite well into what you're going to talk about. So no strong result in terms of which is the most important type of corporate event. And the most important question at the end, should the Super League exist I'm glad to see that the majority believe it shouldn't. That's my strong belief. So we'll make sure that makes it into the newspapers tomorrow. Thank you very much. Okay, so let me stop sharing results. And I think I just closed that. So, very quick overview of IEX Cloud for those of you that don't know us. IEX Cloud is a platform that connects data sources to systems and people that consume data. And we do that with a platform that can service billions of API calls a day. And that number amazes people. And with very, very low latency, so sub 10 millisecond latency. Our commercial and technical frameworks are aimed at lowering the barriers for all market participants to get access to the data they need. And we're doing that by engaging with and encouraging the ecosystem of data providers, fintechs, and other intermediaries, application developers, and end consumers. We've grown a lot since the platform was launched in the middle of 2019. And we now have customers in over 120 countries. I think we're up to about 160,000 users. We have a core set of financial data, which includes stock prices, fundamentals, crypto, Forex, estimates, as well as a premium data offering, which is a set of curated alternative data sets made available from third parties. Our model is completely different to the large aggregators. Our platform is designed to work seamlessly with data sources and experts like Wall Street Horizon. It's a federation of deep subject matter experts, which means we provide a best-in-class set of core data, all at a really accessible price, both for individuals, fintechs, and institutions. For those of you who've not heard of IEX Cloud or IEX before, I really encourage you to read the book, Flash Boys. It's a real page turner. I'm about to start reading it for the second time. IEX is really IEX Group is really the source of both our technical and cultural DNA. And of course, our source for real-time equity prices in North America. The IEX Cloud API makes it easy to query Wall Street Horizon data by ticker, by date, and also whether the underlying data has changed. We currently have next earnings date in our core offering, and we'll be adding IPO dates, splits, M&A, and buybacks, as well as I think shareholder meetings as well. And then everything else you'll hear about is also available in premium, which can be subscribed to on the site. For more information, do go to the API documents at IEX Cloud. And so I'm going to hand the controls over to Christine. Just one moment, let me do that. Okay, so if you want to take control, Christine, I just had one thought to kick things off. The efficient market hypothesis is really basically says that all known information, all public information is already priced into the security. But in order to be able to make a real assessment as to whether the security is fairly priced, you need to know what is in the price, what's out in the market, and most importantly, when it changes the potential impact on the price of a security. And so without further ado, I'm going to hand over to Christine and Michael to run through their thoughts on corporate event data, and then we'll get to some Q&A at the end.
Thank you so much, Tim. I think that was a great lead-in, and I hope that we, answer that question for the audience as we go through these slides. Good afternoon, everyone. Thank you so much for joining us. As Tim mentioned, the topic of today's webinar is something we like to call corporate body language. So that's being aware of both the events as well as the changes to events, the timing, the content of those events, and seeing what that might say about the underlying health of a corporation. Just going to do a quick intro here. My name is Christine Shore. I'm the VP of Research here at Wall Street Horizon. I've been covering financial data, working with financial data for the last 15 years, mostly with a focus on earnings data. So happy to see that question in the poll, although I'm sure to Mike's chagrin, who has been also working with earnings data for a while, and we're so much more than earnings data, and we'll get to that. But anyhow, my role here at Wall Street Horizon is to take a look at all the great data we have and kind of figure out what the narrative is, both around a company or at a sector level, what's the story. And so we're going to share some of those insights with you today. And then at the second half of today's presentation, Mike's going to talk a little bit about data quality and some of the academic research around our data. So Mike, if you wanted to quickly intro yourself now.
Thank you, Christine and Tim, and thank you all for attending today. I know your days are very busy. I'm Michael Rains. I'm Director of Quantitative Data Solutions at Wall Street Horizon. I'm happy to be here, happy to talk about these data today. Along with all the global investment firms that I work with, and you can think hedge funds and investment managers and brokerage and trading firms and everything from prop shops to systematic to options trading, to buy and hold, long and short, across the gamut. I also conduct all of the independent academic trials, that is, in academics from around the world, again, at their respective universities, make use of our data in order to conduct research of their particular passion. You can think about business departments, finance departments, and then subsets of all of that. Accounting, and that is all without any payment. We do not pay these academics to do this work, nor do we hold any editorial control. So across the floor, my job really is to make sure I understand the data and the use cases of the data and help to work with the consumers of that data at Wall Street Horizon. Christine?
Great, thank you so much, Mike. Just briefly going to go over our company background. Who are we at Wall Street Horizon? Well, we have been exclusively focusing on forward-looking corporate data for the last 17 years. We currently collect over 40 different event types that I'm going to get to in a later slide here. And we cover 9,000 public companies. So the breakdown of that is roughly 4,000 US, about 700 Canadian, and the remainder being non-North American, which we choose based on client requests, and we follow the indices and also pick the most tradable names. A little bit of an agenda for today. Like I said, I'm going to take the first half of this, and I'm just going to answer some basic questions around what do we consider a corporate event, why are they important, and then some applications and sort of insights that we found in our data set. And as I mentioned, towards the second half, Mike's going to look at data sourcing and quality of data, as well as he mentioned just all the academic work around the Wall Street Horizon data set. So here's the events that we currently collect. You see they're in a bunch of different buckets. Let me just start off by answering, what do we consider a corporate event? Well, it's anything that a company hosts, sponsors, broadcasts, speaks at. That's what we would consider a corporate event, where they are disclosing information about themselves. What we've noticed over the years is that companies are disclosing information in new and different ways. It seems to be happening more and more recently, and that is due to regulatory practices, MiFID I, MiFID II, as well as the lessening role of brokerage research. So companies have a need now to be more transparent, to go right to their institutional investors and disclose information. You'll notice, for instance, on here under on the left-hand side at the bottom under corporate events, there's forums, there's seminars, there's summits. We collect all of this data. We know who is holding what type of event. And these are events, if you attend, you're not going to typically hear this information anywhere else. And so that's why it's important to be aware that they are happening and to be tuning in. Events changes. So when we talk about why are events important and why it's important to have accurate data, well, there's a couple big reasons. One, we know volatility happens around these events. And so our main client profile are those that are invested in single stocks and the only other underlying options. They need accurate event data so that they are aware of volatility that's coming up so that they can be prepared. And they use this both in trading and risk strategies. So volatility is the number one thing. Also, there are untapped sources of alpha in here, which we will talk about when you see revisions to the events, both the content, the timing, whether it be time of week, time of day. And there's also, risk mitigation and things that you should be aware of. And that's stuff that we really only see when you know the level and you know the degree of the data that we do. And you know the changes and you're kind of aware of the patterns in the sequencing in that data. And then I'd say the third thing, and that makes our data really unique, is that it's primary sourced. So this is one of the few places where you're getting information from the company itself. You're not relying on a news story, you're not reading an analyst's note. This is the company disclosing information about themselves. So I want to jump into a few examples now, just so you can get an idea of how we look at this data and what we would sort of conclude. So I'm going to start with some examples from last quarter, examples where companies confirmed an earnings date that was outside of the expected window. And so a couple of things here. These are instances in which we had an expected date, and that date was based on our 17-year history and understanding how these companies report. And when the company itself actually confirmed their earnings date, it was outside of the range that we would expect. And we collect this data and we use something called a date breaks factor to sort of rank where it falls. So our date breaks factor is a proprietary measure by Wall Street Horizon, and it uses a modified Z-score protocol, and it looks at the standard deviations from the norm to capture when a confirmed earnings date is deviating from a historical trend for that quarter. So we know these companies so intimately that we can tell you, for instance, they always report Q1 earnings on the second Tuesday of Q2. And when they, are out of line, a red flag goes up and we alert our clients. And, it's not always that they have negative news coming up. And I'll share with you in a second how we think about this. It could just be, a mistake. I think at least every quarter our team calls an IR team somewhere and asks a company, you always report on a Wednesday, and now this quarter you're reporting on a Tuesday, and you haven't done that for 5 years. And sometimes it just is a mistake. Sometimes there's a change in management. So there can be a lot of different reasons. But typically how we think about a company that has pushed their earnings date back, later than they typically report, is that it's possible they have bad news to share. When they pull it forward, it's possible they have good news to share. And Mike will talk a little more about that when he gets into the academic research. But we assign a date breaks factor from -3 to +3. -3 represents companies that push their earnings date back later than we'd tend to see it, and a +3 meaning they pulled it forward. So let's talk about a couple of the positive date breaks from Q1. Zillow is the first on our list here. And you can see we're usually very accurate with Zillow. We're typically, our estimate is within 3 days of when they confirm their earnings date. But for Q1, they actually moved their date 7 days earlier. So that meaning, that would set off an alarm for us to say, oh, they might have something positive to share. They've moved their date a week earlier. Sure enough, they reported, they beat expectations, and then the post-earnings drift period, the stock traveled up 17%. Similarly, MongoDB, you can see we're also very accurate there. They also pulled their earnings date 7 days ahead. Stock went up 14% afterwards. Now, on the flip side, our negative date breaks for last quarter, maybe the first one for anyone that covers Harley-Davidson, not so surprising. They had a lot going on there, but typically we're within 5 days, or our estimate is within 5 days of their confirmed earnings date. They actually pushed their date back 7 days, and that resulted, once they reported bad news on their call, the stock dropped 21%. Now, Roku was one that I would say was surprising in the other way, in that they were sort of an early darling of the stay-at-home period and the pandemic. They had a couple really great quarters, and then we noticed this sort of early sign where we are very accurate, usually within 2 days of their confirmed earnings date, and they pushed their date back 7 days. And again, they reported disappointing results, and the stock actually dropped 9% in the period after earnings. So these are just a few small instances that would at least, a light bulb would go off when we'd say, I want to investigate this a little further. You're not going to use this as a signal. You're not going to see the Roku news and say, okay, I'm dumping all my Roku stock. you're going to pair this with other bespoke data sets like your fundamentals data, your pricing, your market data, and you're going to start to build a mosaic. And so, for instance, with Zillow, we know anyone that reads any piece of news knows the real estate market is on fire. So, and if you look at the last few quarters for Zillow, you know, their earnings have been great, revenue's strong. And so you would just pair this, and it just adds a little more color to the story as you're building out your research strategy. It's not just the event dates and the changes to those dates that kind of alert us that something's going on. We also look at confirmations. So when is a company confirming their earnings date? We track, you know, how far ahead they usually do. For instance, do they confirm an earnings date 10 days before the actual report date? And maybe this quarter they've dropped it to 5. And what does that say? Maybe they're not looking forward to sharing what they're going to on that call. And so I just want to draw your attention to this table, the yellow highlighted section, because I think it's the most compelling. So this is our indexed universe. So it's about 1,500 companies, that the largest, most liquid companies on indices such as the S&P 500, Dow Jones, NASDAQ, Nikkei. And you'll see for Q2 2021, so the earnings season we're in right now, as of this week, 71% of companies have confirmed their earnings date. You look at the year ago quarter, that was only at 63%. So perhaps that's not too surprising. We were in the midst of lockdown. Companies weren't sure what was going on yet. So they were kind of pumping the brakes on committing to an earnings date. But even so, if you go back the 3 years prior, you'll still see we're running ahead of schedule as far as earnings date confirmations. And to me, this is just a great piece of information to pair with everything else we know going into this first quarter earnings season about how bullish and optimistic the season is going to be. And you can say, yeah, easier year-over-year comparisons. Certainly there's a lot more positive things happening now versus the year ago period. But if you take this piece of data, you pair it with the fact that companies are providing higher guidance than they ever have, and analysts are increasing estimates coming into the earnings season, then you've got a little more of a fuller picture. And so I think this just supports all of the other data that we're seeing heading into the peak weeks of the Q1 season.
Hey, Christine, we've had a question, but it might be one for Michael later, so we can wait. But it's asking a question about whether you've built a model, and if yes, how many, I guess, you know, some kind of back test to look at performance, and how many companies did you take into account? You've got that broad index, but feel free to defer that until Michael. I think Michael, probably you'll be referring to some academic research, which might better answer that question. But I thought I'd put that out there if you wanted to.
Yeah. I mean, I think they're asking did we build a signal?
Yeah.
The answer is no. The short answer is no. I'll let Michael talk a little more about that later and why. But yeah, the answer is no. We don't have a signal built around this, and there's very specific reasons why.
Got you.
All right. So moving into you know, I mentioned earlier, companies are disclosing information in new ways all the time. So we are really up on the ways they are disclosing information, and you have to be aware of these patterns. You know, is a scheduled date sporadic? Is this the norm for them? Are they, you know, very committed to a time or day of week, as I mentioned? And not only that, we also look to see when there's a confluence of events. So this is something we call an event cluster, or there are a lot of things happening at a company at one time. And what does that say or not say, depending on whether they have a packed calendar or not. And I'd like to jump into an example because I think this really lays it out. And I love looking at TripAdvisor. I know this space has been highly watched, especially as you know, a main beneficiary of the reopening trade. So this space includes Booking.com, Travelzoo, Expedia, TripAdvisor. And again, if you know anything about the space, you know that it's poised to benefit as people start to travel more. But which one of these companies do you invest in? And I think that's really the difficult thing with stock picking is the space overall is good, but how do I decide? And right here, what I'm showing is the TripAdvisor price chart, and then some of their recent events plotted on that price chart. The first being we noticed that for their Q4 report, they reported on February 18th. They then had their earnings call the very next morning. They beat analyst expectations. They had a very rosy outlook, so the stock went up. And then we started to notice they had a lot of conferences coming up in major, these are high profile financial conferences. So on March 1st, they spoke at the JP Morgan Global High Yield and Leveraged Finance Conference. On the 2nd, the very next day, they were at the Morgan Stanley TMT Conference. And then the next week, they're at Deutsche Bank's Media, Internet, and Telecom Conference. And so that kind of set off an alert in my head. That's a busy schedule. That's a very tight range. I want to know two things. One, who was speaking at the conference, because that matters. And the CFO of TripAdvisor spoke at all three conferences. That's a very high profile person. They're in the C-suite. It wasn't, a mid-level person. They were sending their CFO. So that's something I would want to know. The second thing I want to do is take a look at the peers, the ones that I just mentioned, Travelzoo, Expedia, Booking.com. Were they participating in these events? And I think with the exception of Expedia, who did, I believe, Morgan Stanley, that was it. Their presence, they did not have a presence at these conferences. And I would want to understand why. I'm not saying that if you're going to a conference, if you're TripAdvisor, that it's because your financials are much stronger than your peers. What I am saying is that, you're not going to go to a conference and share bad news about yourself. You're only going to share good things, but just your presence there elevates you above your peers because you're going to get more media coverage. Your name is just going to be out there. We know perception is reality, right? And so now they look like thought leaders in the space. TripAdvisor is going to get a little more attention here. And so that's exactly what we've seen. If you look at the stock chart and if you do that comparison with the peers, I think year-to-date TripAdvisor is up around 87%, followed by Travelzoo's at about 78%. Booking.com, what was it? I think it's only about 13%, and Expedia is 34%. So the space, as I said, every player is doing very well, but if you had to pick and you saw fundamentals across the board for all of them were looking great, this is just a little extra color that would help you choose and say, hey, why is TripAdvisor so involved? And these are things that we like to pick out, these event clusters. And again, they don't always line up. You need to really be on the search for them. But it's something to help add to the narrative when you are looking at, adding to your trading and your risk strategy. So I want to leave you with that thought, and I'm going to allow Mike to share his screen now and kind of take some of those points a little further.
Thank you very much, Christine. Everyone see my screen? Thank you very much. Well, let's start off with an academic. Let's talk Professor Ed DeHaan. He's currently at the University of Washington. Ed previously was at Stanford University. And I know it's horrible when people read slides, but I want to read this one. Our ability to learn from the past and predict the future is entirely dependent on the quality of the data we use. Bad data causes bad research, wasted hours, and lost investment dollars. And working enough with academics and with investors around the globe, this is true for capital markets as well as academia. We have to think about the data. So what does that mean? Why do we source it? How do we source it? Well, Christine was good in pointing out companies. Is it on their website? Where on their website? Is it a letter from the chairwoman that gets posted? Is it over on the IRO page? Is it new events? Is it an embedded video somewhere on the website? Is it an RSS feed? Is it Twitter being cute and Twitter only likes to tweet its information? And you got to make sure to watch Twitter for that. Where are they putting their information? Or do they delay and they wait till their regulatory filing? And then is it there in the regulatory filing, and you need to read through those to get what the company is saying. Or do they take a phone call? We want to know that. Will they take a phone call? Will they take an email? What day of the week? Who takes those sources of information? Who likes to reply and when? So I want to be able to go directly to the company itself for a number of reasons, and that addresses point 2. For the purposes of your Department of Compliance, you need to have this publicly sourced. You know, if someone calls me and asks me, Mike, where did you see that John Deere suspended that dividend? I need to be able to report where that company divulged that information. I cannot just say I saw it somewhere. As you all know, that meets the terms of compliance when I've sourced it with the company, but there's another very large reason why you want to do that, and that's for accuracy. Did they really suspend that dividend? Well, the company told me they did, right? So that's the source. I want to go to it. What does that mean then? Well, the person that you're working with to obtain that data, let's say you say, okay, I can't gather from 9,000 companies like you do, Mike. So, but what I want to do is I want to understand very much how you did that. So this is where it's really important. At Wall Street Horizon, humans beat bots. I'm sorry, I know the bots want to win, but humans still are wonderful. Why? Humans still into it. They understand the nature of a company because most of our analysts have covered the companies for decades, right? They can tell you, this is where we found it, this is how we knew it, this is where we have obtained it. If you can't get that sourcing question, those series of sourcing questions answered by the individual you're talking to, then I'm sorry, it's suspect. It runs afoul of compliance and it runs afoul of accuracy. And if you're going to integrate that into a systematic trading model, you're really risking your profit, let alone your capital. And the engineers, let's not forget this. As you know, everybody out there is a proponent of something, R code or JSON, or I still have people, of course, that use Excel spreadsheet links and DDE links. I mean, there's all kinds of things out there, but why not also involve the engineers who have formatted the data that is being provided to you? So if you have a question, in my case, primarily XML tags, you want to know the contents, you want to know the abbreviations, you want to know, is everything tagged? Do I have to rely on NLP in order to understand your data? And so I want an engineer at this point to help walk me through actually the technical details of delivering the data to me. And for once I start delivering it, ingesting it, and understanding that I'm making the best use of the data that's being transmitted to me. So it's a given then. It has to be repeatable. At a certain point, you don't want to call me anymore. You don't want to second guess me. You want to say, great, I got the updates on these different types of events. I've incorporated it into either a risk or a trading strategy, and I'm good to go. Along the way, I may have questions, great. But I want to be able to be confident in the fact that I've got an ongoing source of data that meets all of the strictures of my firm, or in, of course, other cases, along my academic rigorous studies, so that I get the data I need to do what I need it to do. Let's go one more step, just the last point. They've got to be able to deliver you detailed specification guides. This is something that, again, I'm surprised time again, that if I don't have a detailed guide, I can't just suss it out. If you've got forward-looking data and an event type, and it has several unique characteristics, I would like a tech spec that explains every data point in there, every tag item. If you've got the corresponding history, then I want a tech spec for that as well. I want to be able to compare the two, and I want to be able to have access to the tech spec for the history, so that I know, let's say if I'm doing a study, what I'm looking at as compared to what might have been in the forward-looking data. So again, you want to go directly to the source. That history data I just mentioned, we can go a little deeper in that, in the sense that, did they tweak it? Did they buy it yesterday? Was the history known at the time the event occurred, or did you source it later? Again, as long as you're being told that, that's one thing. If you're not being told that, you've really missed a lot, because again, can you tell me the market knew about this event at the time that the market was open and trading that company or series of companies. You need to know that. So it's very important, for example, to archive your history as you publish it, which is something we certainly do. Now, I don't go back in, warts and all, I am human. I can make a mistake, and you will find a mistake in my history and you will point it out to me, and I appreciate that because it helps me improve my forward-looking data sourcing. But in this case, I haven't changed my record because guess what? I published it at that time. Now, if there are reasons where subsequent to an event, there is a plethora of new information that I can obtain, I may then say I need to create also a concurrent history log, which I call a change log, which is I knew data after the event. And so here's some stuff I learned after the fact that is germane, but honestly, I don't want to imply that I knew it at the time of the event. So therefore, I don't want you to make a consideration of how that impacted the market or not, or how it impacts your history or not. Again,
Michael,
yes, sir.
What's the time delay between typically an event being posted and it kind of coming out of your process in terms of checking it and validating it and it becoming a record of yours?
It's a very good question, and it really depends on the need, and it depends on the event type. As you can think about it, something like earnings per share, and in a given day, all of a sudden we're reporting on 1,200 companies, let's say. What we do is we have to update that data every 5 minutes. So every 5 minutes, we want to tell you who has released, $1.3801, at 12/20/2021, date stamp, original currency, boom. Other things, a conference, those tend to be scheduled out a ways. That kind of data I'm updating every 3 hours, right? Now, there are two event types that you're right, and it speaks a little bit to IEX and Michael Lewis, and the fact that there were the Chicago people and the options traders and I'll call them the pounce, the opportunistic pounce traders, who said, could you get to me the next confirmed earnings date quicker than every 5 minutes, right? Well, to be honest, we are not in the high frequency business. That's not something we try to do. We don't try to offer microwave technology, but what we did do is say, if we could get that, if we could get the next earnings date, which is really, as you know, a lot of people are interested in, and the second event type would be announced dividends. We said, if we can get that to you within 2 seconds, is that fast enough? And that would be through a streaming socket approach. And you can imagine the type of people that would be asking for that data as I referenced. And again, XML content, and it's just pipes that are streaming directly through their firewall, and they're ingesting it, catching it, and working with the data. Let's get into the academics. Let's head to Northwestern and Kellogg, and that's Matt Lyle, Andrew Stefan, who else am I forgetting here? Oh, Terry Young. So Matt's at Northwestern and Andrew is at University of Colorado Boulder, and Terry is over at Emory University. Simple idea they had. Some people announce before market, some people announce after market, doesn't matter. And we know that it's about 48% before market, 52% after market, all right? And that can change, but as you can see, it's somewhat even. And again, what's great about the academics, even though when you go to some of the conferences where it's academics versus capital markets, they both throw darts, but that's okay. The good thing is that they're the ones that do the empirical studies that may prove anecdotally what we've assumed all along in capital markets. And in this case, they said, if you announce after market, guess what? People tend to have more time to digest your news, understand it, and pretty much the price reconciles to where it should be once the market opens. If you announce before market, there is more volatility. And if you think about it, it makes sense. The day gets ahead of you. Okay, you've read a report at 9 a.m. about a company, but all of a sudden the market's open. There's now another 1,000 reports coming out. You're not sure where this stock is going to be priced. And so you're going to recognize some volatility that you don't see in those markets that are after. Classic case of this is Warren Buffett over at Berkshire Hathaway. Him and Charlie would tell you, we announce on the weekend, we announce on Saturday, because we want you to understand the numbers. Plus, it's more fun in Nebraska on a Saturday. And so that way you can really understand what we're saying about the numbers for our company. This next study, that's Travis Johnson over at University of Texas and Eric So over at MIT. Again, this speaks to date breaks what Christine said. It was something we would observe, something that we saw in companies time again, delaying a report. And basically, you can summarize this by, you've got good news, you run home to share the good news with your family. You've got bad news, you might delay getting home as quickly. And that's really the notion here. And they empirically, of course, studied, and maybe to your earlier question, this is a study that looked at about 4,000 US companies and said when they delayed their earnings date. And here's something that we need to think a little bit about. We used to think it was linear. At the end of an earnings conference call, they would announce when their next earnings date is. Now, that may be true with some companies still. Some companies may actually now say, we've tentatively set a date, or they won't tell you anything. And so once in the absence of that, we will forecast a date based on our history and knowledge of the company. But it's the data analyst, the human's job to go and determine how accurate is that data and how quickly can I confirm with the company what their next verified date is. Well, guess what? That changed the nature of where it went from tentative to verified or confirmed. Now you could get a tentative to a tentative issued. You could get a tentative to a verified to a verified, which is one of the scariest ones that University of Texas and MIT looked at. That is the company itself disclosing their next earnings date and then pushing it out further with a second new verified date. Again, speaks to the fact they're delaying. Noted, Christine well said, I'm not saying in a vacuum, this is what you trade on. No, this is a bit of your barometer. They looked at it not only for around the times of earnings, but they also said, let's go out a little further and see if there's a tail on it. And that's important because if you're going to research the company, you're going to say, yes, there was a wiggle here around earnings and it didn't look good. And that just reverberated on out the next few months. There's a cash flow, there's a management problem, all the other data sources that you're going to use to explore that. I think I covered that. I don't think we need to go into that. UPenn, they are all from Wharton, Bushy, Taylor, and Shu. The dark side of investor conferences. Here we go. As Christine noted, we don't just look at earnings dates. We like to talk earnings dates because everybody likes to talk earnings dates. But in this case, investor conferences and events speak to the fact, as Christine said, that more and more companies want to divulge directly to the investors themselves information that they have about their company. MiFID 1, MiFID 2, now MiFID 2 is changing, Reg MS. Also, they don't want somebody else perhaps interpreting, they want to be the source. Well, that means that traditionally what we would have called a conference, we now have broken down into 11 subgroups. You know, you get capital markets days, it may be Europe, Northern Europe, but you're going to call it an analyst day here in the States. You're going to get a summit, a workshop, a trade show, a format, an R&D day, a business update. They're all using these terms, and when we see broad acceptance by publicly traded companies, that use of that term for that event, we'll adopt it and we'll embed it into our investor conferences and event data. And in this case, these academics said, well, what does that mean? They have a target out there. As I said, investor conferences and events get set in the future. Usually it's confirmed. Meanwhile, you get updates throughout it about speakers being added, the location, the venue, the agenda. Well, what happens along the way, and what they said happens, is that there are a suite of executives who kind of leak information, divulge information. I'm not trying to be pejorative here. They share information ahead of the event. And when they share that information, it tends to benefit the price of the stock. Now, what they've also found is that there's an awful lot of these insiders who tend to trade ahead of the event, and they did show an increased amount of activity of trading ahead of the event because they were shaping the narrative, right? And that allowed them to be opportunistic in the fact that the elevation of the stock was a good time for them to sell. And then in the course of their study, they found that post the event, if they continued to share additional information, it didn't seem to have as much of an impact on the price of the stock. All right, I've gone through that pretty quickly, and if you want to read any of those papers in their entirety, we have many more. It's all independent research. You just go to wallstreethorizon.com and you can read each of those papers as you wish. All right, so we understand why publicly traded companies, why we want to know about these upcoming events as soon as possible, but as accurately as possible, because they cause volatility in stocks and the underlying option. We want to observe patterns, not only because we say, well, this company always discloses something on the IRO page, or they always announce at this time, but what happens when they deviate from that? What happens when it changes from what you think they're doing? Again, alongside your other bespoke data sets. And academics have used the same data that investors are using for trading and risk strategies to advance their own particular research and what they profess in. And those articles tend, once they migrate out of the paper stage, of course, think of the Journal of Accounting, Journal of Quantitative Finance, Journal of Finance. You will see them in major publications, as well as you will see the popular press, Wall Street Journal, even all the way to USA Today, will invite these professors in so that they can learn more about the market from that standpoint. And finally, I certainly have firsthand experience with hedge funds that invite the academics in to review the data and some of their thinking. And that's what I've got for you today.
That's
Tim?
great. Thank you, Michael. I think we have some of the links to those papers on our website under the API documents, but I'm assuming that those links are also on your website as well.
Yes, sir.
So that was a really good run through. I had a personal observation when I covered Latin American stocks. I noticed that most companies would report after the close, and some of them would report at midnight or 1 in the morning. I don't know whether they all went out to the cantina beforehand or whatever, but I definitely started to notice that if companies had bad news, it was like the early hours of the morning. Have there been any studies that look at other countries and variations? Because obviously this is very kind of US centric research.
Yeah, it's probably US, Canada, and probably Europe a little bit. And you're right. And the studies have not gone so far into South America, but in a little different way. Smaller companies who want to attract attention for the potential of gaining new investors might actually report on the off time, because people are watching for companies that are not going to do well in the off time. And here they catch a little gold nugget who says, I'm going to report on a Friday afternoon, which anecdotally used to be bad news because the market's closed. But instead, we all goof off on Friday and surf the web, and here we find a company with good news, right? Yeah. So I think, though, currently there are studies that have been done by international academics. I'm thinking about Monash here. I did a study, as well as Tilburg. They took a little board look, but I don't have specifically a South America example.
Gotcha. Another question, it goes back to, I think, a point that Christine made earlier about the mosaic. So can you kind of just go a little bit deeper on the other data sets that you would look at, that typically customers look at alongside, the kind of core event data?
Yeah, absolutely. So as I mentioned, certainly you want to have your core fundamentals data set. So earnings, revenues, everything else that you would look at in a 10K and a 10Q to understand the financial health of the company, pricing data, market data, just an overall understanding of the space of the company that you're looking at. And again, this is just a piece of data to pull into that and, either confirm or at least make you question everything else that you're seeing, because it is forward-looking and we do have research to back up what it could be saying. you know, if you're really into the earnings calls and looking at the earnings releases, that's you know, backwards looking, and there might be clues and forward-looking guidance, which is oftentimes it's gotten a lot more vague. It's very short term. There's often been times, you know, Larry Fink, a lot of high-profile folks in the financial world have called for an end to corporate guidance because you don't always get that much out of it, and it is very short term. And of course, when you're investing, you know, oftentimes you want to take a longer term view, understand what the next year to 5 years looks like, not just this quarter to quarter view. And so this data will help you get a little more forward looking as companies, you know, the banks, for instance, they'll release their earnings schedule a year in advance. So they'll, you know, back in April, or I think even earlier in the year, they said, here's kind of all the earnings dates for the next year. And so you kind of have an idea of what's coming up. So you can't always rely on what the companies themselves say, because they will certainly try to spin and make it look a little more positive than it should. And then that filters into analyst estimates. That's the reason you can't just look at sell side estimates. They often go off of corporate guidance. They move it maybe a little bit, a penny north, a penny south of what the expected EPS is. But they don't want to lose the relationship with the company. They're really there for corporate access. So not to say, like, you need to look at these data sets. Everyone has fundamentals data. Everyone looks at guidance and estimates. But when you're building that mosaic, it's nice to have other things to put in there to either confirm your view or to kind of make you question what if the company's giving great guidance, but they keep pushing their earnings date back. That would maybe set a little red flag off in your head.
Yeah, when I think about your chart and, you know, companies showing up at events, I would immediately then go and look at short interest and insiders. You know, are the insiders selling into that curve?
Yeah, absolutely.
If a CFO, not that with that company you mentioned would do this, but if a CFO is long the stock, obviously they have an interest to kind of get behind some positive news. Good. I'm just looking at the other questions. One question here: where can we find specifications on how the data is assembled? So I guess your kind of taxonomy in your process. Do you publish that, Michael or Christine? Is that something? Obviously, there's some secret sauce in there, but what do you put out?
We don't really explain. I mean, as much as Christine and I have explained it today, that's pretty much it. Yep. The details would be like in the IEX API document, right? You would actually see each element and what the content is, and be able to know. I mean, in some of the data sets, of course, we'll always include a URL to the source document. So in the case of a company issued press release for an EPS or an announcement, we're gonna say, look, here's the document. You go right ahead and read it. In the case of date breaks that Christine illustrated, we'll go out of our way to say, we made the revision to the date because it was one of our proprietary algorithm projections. We made a revision to the date because of the work of one of the data analysts, or we made a revision to the date because they disclosed in a company issued press release this new information and we captured it.
Yep, and that's in your metadata, right?
That's in the data.
And do you know if customers, this is a related question, are using that data to train machine learning or doing AI type studies on the data? Because obviously there's a lot of complex kind of signals going on there. Are there any kind of machine learning type models that you're familiar with?
Yeah, and again, that's why we don't do it. Christine had mentioned that. I'm not here to tell a portfolio manager how to trade. That is not my job. That is their job. I'm here to provide that clean, accurate data. So think about a use case. I had an options trading firm that took 10 years of those revisions against their previous 10 years of options pricing, and said, had we known this, how would our portfolio have performed in each of those years? And took their actual trades and did evaluative studies, right? And then went on to create a way to quantitatively put in a systematic operation. So they're getting the data, they're ingesting it, And you're right. I mean, some of these guys, as you know, their trading is done by 9:40, 9:45 in the morning.
Yep.
So it's called unsupervised, but it is supervised if something goes wrong. So that type of model.
So that's partially answered another question from Thomas. What do you think the split is between customers using your data as an input into a quant model, which I think is what you were just talking about, versus part of the kind of more fundamental research process? Have you got a sense for the proportion?
Well, we do, but again, it's the use case probably that differs, right?
Yeah.
If you were a long, instead of a long short, and you've got a holding pattern, you're not observing the permutations as much, right? But what you are wanting to know is, as far ahead as possible, what is coming at my portfolio, perhaps from a defensive position. I'm not going to pounce on a trade, but what I'm going to do is I want to know as much about the companies that I can. So we will largely tell you that it is split between active traders, traditional asset managers, and even an RIA, right, that is just knowledgeable about the companies. Hey, don't rebalance your portfolio, Tim. There's an analyst day coming and we want to observe that. Or then you do get into the algo guys, right? Or a brokerage firm, that's just going to use it to supplement their information. So broadly speak, it's that whole group of strategies. Christine, did I miss anything?
Yeah, so that.
No, I think you got it, Mike.
Another question, this is back on the metadata, and I can answer this partly from the standpoint of IEX as well. Do you annotate the data or just provide the raw data? From your experience, what data source do the majority of your customers use, or is it distributed? Another way of asking this, which endpoints are called the most? So there's a few questions in there. I'll answer from our standpoint. Certainly in the APIs, we present your data. There's probably dozens of fields associated with the data point, so you can peer into and see when the data was collected and how it's collected and the assumptions that you've made. But I guess that's also made available on your platform as well. Yeah,
because and it's a good question in the sense that Barry and I we worked for big shops where you had to buy everything to get the thing you wanted. Yeah. Well, we highly dislike that model. And so if an individual, yes, and IEX does too. And so if you want to go in and say, I'm just a dividends guy or gal, okay, go in and get the dividends. I mean, you referenced a little earlier, of course, North America is nuts about quarterly earnings dates, or if it's half-year reporters. But, the beauty of it is, you say, well, I don't really observe that. I had a fellow who observed analyst days. As long as he knew 7 days in advance when the analyst day was happening, he said he had figured out a way to pounce on price fluctuations for the stocks in his portfolio, and he knew to trade at that time. So he just wanted to call out to analyst days, very specific investor conference event type, right? So I think you're right. You're absolutely right. It depends on what your trading or your risk model is, or strategy. If it's not a model, if it's a strategy, then find the corresponding data set and you can get that delivered to you.
Great. So we're right at the top of the hour. I would like to thank both of you for a really interesting discussion and presentation. Thank you for all the work you put in. Thank you for everyone that dialed in. We didn't get to a few of the questions, and we'll certainly try and follow up after the call. And we will be publishing the video as soon as we can put it all together. So thank you again, everyone, and look forward to seeing you next time.
Thank you very much.
Thank you so much, everyone. Bye-bye.